Hello, everyone. The time has just passed 2 here in Norway. So with that, it's our pleasure to welcome you all to today's webinar reviewing EU ETS in 2023 and giving you an outlook for 2024. Today's presenter is one of our senior carbon market analysts, Anders Noreng. Amish's main focus is monitoring and analyzing policy processes that both inform and impact the European carbon market, as well as testing and questioning the supply and demand assumption that goes into our models. Before joining Veit, Amish covered the carbon markets for multiple companies such as Thomson Reuters, Refinitiv, and the London Stock Exchange from different perspectives. With these insights, Anish has a comprehensive overview of carbon markets as they develop globally. For the next 45 minutes, Anish will take you through the demand shock and how the sharp drop in power sector emissions weighs on carbon price. He'll have a look towards 2040 with the increasingly tight balance, before he'll conclude with the key policy file in 2024 and the 2040 climate target. We'll have a Q&A session after the presentation, so if you have any questions, we strongly recommend you submit those throughout the presentation in the Q&A section at the bottom of your Zoom toolbar. So without further ado, I give the floor over to Anish.
Thank you, Helena, and a warm welcome from my part as well to everyone on the call. To this webinar, I will try to summarize briefly what we see as the highlights of 2023, both in terms of market events, trading, that is, in the European carbon market, and in terms of ongoing policy discussions. And then, as Helena said, we'll share also some of our expectations for this year, 2024. Yeah, so let's just get to it. I've structured it in these 4 rough parts. The aim is to start with the year that's now behind us, look a bit more in detail on the policy, that's the second part here, and then I'll zoom out a bit to the long-term context, to try to understand, that's to better understand the impact of the policy discussions that are ongoing. And then I'll zoom back into the outlook for 2024. So let's start with the year that has just passed. In this figure, we see our assessment of turnover, the overall value of the European carbon market, which is basically then transacted volumes times the prices at those moments in time. And as you can see here, we go back to 2019 to compare growth year on year. And you could, of course, argue that also 2023 was year of growth, which is correct, and in many ways still impressive given the circumstances. But you could also take a bit more cynical view maybe and see that it shows here signs of flattening out after the really very, very big jump that took place from 2020 to 2021. The figure also shows a breakdown by segment, and no surprise, it's still futures that is very dominant, some 85% of the share here. And I am reminded now that I should put on these figures. Yes. So the turnover was up some 5%, and the split I already mentioned. Actually, volumes overall stayed relatively flat compared to 2022, but average price of 85 euros per tonne in 23 was slightly higher than in 2022. So that's the main reason why we have a slightly higher turnover in 23. And then we just skip immediately into the price graph here. Try to place my own picture so that I don't block the presentation. And I guess what's interesting to see here, it's a lot of information in this slide, but if we start, I mentioned the average price, which you can see here as the blue line at 85, and that compares to the yellow line, 81, which was average in 22, and further down, the brownish one was between 50 and 60, I think 54 was the average in 21. So you see, it is still going up, but on average that is, but not at the same pace anymore. And if you compare, if we look at just 2023, the overall trend was actually negative. Average in second part of the year was lower than in the first part. And the boxes here, show some of the key drivers that we see as important. If you have the look at the two arrows, red arrows that point downwards, that's weaker gas prices, the spring of 23, and again in late autumn. And those were periods where we saw weakening gas prices as an important bearish driver for carbon prices. I will get back to this more in detail, but the fuel switching picture has been placing gas very much in the money throughout most of this year. The green boxes, Fit for 55 adaptation, is the most important bullish driver. That process was concluded politically back in December 2022, but there was still attention on it, at least in the first part of 2023, because there was the confirmations in Parliament and in the Council, and then the final adoption in, I think, 10th of May 2023. And that was, we see that as one of the main reasons for, behind the upwards push in January, February, which took carbon to breach very briefly the 100 euros level on 21st of February. But then throughout the year, fuel switching, squeezing out coal from the power mix, and in addition to several other important bearish factors helped push prices down. One of them was the Repower EU auction volume increase. I'll get back to that in more detail as well. There were also slightly larger daily auctions due to the TNAC calculation, which I'll also cover in more detail. And then as the year passed, there were increasingly gloomy indicators coming out for the overall economy, which bodes ill for demand for EUAs. When power sector emissions are down, when industry activity is stagnating or in recession, it suggests a lower demand for EUAs. So this figure shows how the overall, there we go. Now I see more of the screen. The total number of allowances in circulation, which is the European Union, the official surplus indicator. It's a calculation that they make every year in May, and which then serves as basis for how much of the surplus that is absorbed, withheld from auctions and put into the market stability reserve. And what we see in this picture is that we now reached the lowest point ever in 2023. So because of what has been absorbed in previous years, the surplus is going down. We saw, if you go back to 2020 or 21 here, there was actually an increase as a result of the COVID effect, dampening activity in 2020, leading to reduced demand for EUAs in 2021. which otherwise we would have expected to follow the curve that was in place before the COVID pandemic. And maybe for us, the most important and direct impact of this is that as the TNAC decreases, so does the withholding of EUAs from the auctions. So from September 23 to 31st of August 24, there will be less EUAs withheld and more EUAs being auctioned. So that is also a bearish factor that played into the prices in 23. Another point that is worth noting, 2023 was the first year of invalidation from the MSR. Some 2.5 billion allowances were invalidated or cancelled, eliminated. And that is roughly equal to 2 years of emissions. So that means these volumes have been permanently removed from the EU ETS. Yeah, obviously the impact of the power mix is very important for emissions, and what we saw changing quite dramatically or significantly from 2022 to 2023 was how there was both an overall drop in demand because of energy savings, reduced activity in industry, households being more price conscious. So the total generation was down. And then, as is shown in these figures here, the relative share of fossils versus renewables shifted quite importantly. So you see coal, for example, down from, this is in terms of generation, right? So this is terawatt hours, down from 428 to 310. Gas also down, although not as much, 499 to 412. Whereas renewables, this is combined hydro, solar, and wind, up from 1110 to 1240. Whereas nuclear stayed quite at the same level. So this obviously led to much less demand for EUAs from the power sector. Overall, we estimate power sector's emissions down 20% in 2023. Yeah, okay, here comes the point. So here you see the same in percentages. Coal down 27%, gas down 17%. And the result was power sector emissions at 574 million tons. That's our preliminary assessment, which would be down 20%. Obviously, a very important bearish factor for carbon price. Yes, and then there is the, as I showed in the first price curve, the how we see falling gas prices as an additional important element. On this figure, we see the light-colored curve here is the front December EUA price throughout the year. And then the darker line is the front month CO2 switching price, which says something about the theoretical cost for switching power generation from a 39% efficient coal plant to a 50% efficient gas power plant. And the point here being when that fuel switching curve is below actual EUA price, it means it's profitable to switch to gas or to run on gas. So gas is in the money. And that, as you can see, has been the case throughout much of the year. Not in the very early months, where there was probably still some uncertainty about what would be the demand for gas for heating. And then as it, the confidence grew that the storage levels were more than sufficient, gas prices dropped, and they picked up again in autumn, but only briefly before again they dropped on quite ample supply. So that's of course contributed to the power emission decrease, but we see the main reason is really the demand drop. Obviously, if gas prices had been higher, there would have been less gas generation and more coal generation. So that's how that played out. If we look at industry, we see these are actually Eurostat data comparing output. So again, not emissions, but industrial production for the first 11 months of last year. We are still waiting for the December numbers, but this is a year-on-year comparison, and it shows quite significant contractions in all main ETS segments. We have especially for chemicals here, a little bit less for oil and gas, but this in a way confirms, gloomy situation, gloomy economic outlook for European industry. So if we look at our own assessment of industry emissions in absolute terms for the whole year, we see an output of 581 million tons of CO2, so roughly in line with the power sector, and that is down 1.5% from 2022. And for both sectors, of course, power and industry, the final numbers will be known with the verified emissions that will be revealed on the 2nd of April. So one of the key events this year was the start of the Repower EU monetization by selling auction volumes that had been planned for other purposes or for later years. It's partly sourced from the member states' budgets for the years 27 to 30, and partly from the Innovation Fund. And maybe a quick reminder is in place here that the Repower is a program that the European Commission suggested in reaction to the invasion of Ukraine in 2022 and the ensuing energy crisis. So it's basically meant to wean Europe off its dependence on Russian fossils, and to, in a way, jumpstart the green transition to accelerate it. Most of the funding for this comes from the post-COVID program, but an additional 20 billion euros is to be monetized by selling EUAs. So this pie chart shows the auction revenues last year. All in all, 43.6 billion euros. And of course, the lion's share here is what goes to the member states' governments, 3/4 roughly. Modernization Fund takes 13%, Innovation Fund 4%, and Repower EU takes 7%. And well, roughly half of that, 60%, is redirected from what would otherwise be Innovation Fund, and the rest is taken from the member states' volumes intended for later years. So you can see the same. Not sure what is happening now here. And here we also have a breakdown on the right-hand side between the main beneficiary states, which is of course by size of the economy. So Germany, Poland, Italy, Spain, France. Well, or rather than size of economy, size of emissions, their share of the total emissions in the EU ETS. And then a few words on policy files and events that took place and were important in 2023. So the repower was, as I said, something introduced or conceived in 2022 with the target of raising 20 billion decided back then. But since that was agreed, there has been a lot of focus on just exactly when and for how long that sales would last and how much volume would be brought to the market in 23, in 24, etc. So overall, the period goes, the first sale was in July 2023, and it's meant to end by August 26 at the latest. If they reach the 20 billion before that, then they will simply stop this this monetization. Then, of course, as I already mentioned, also the Fit for 55, which was in many ways the key price driving element throughout 21 and 22, and into 23, even though all the details had been politically agreed. I think there was still some, eagerness to see that everything was finally confirmed and put into effect. Another file, which is very closely linked to the ETS directive, is the CBAM, Carbon Border Adjustment Mechanism, of which we hear mainly more reactions on an international level probably these days, with many of Europe's trading partners voicing strong reservations, but nevertheless the program is going ahead and started a so-called transitional period on 1st of October, meaning that importers of the type of goods that are covered, that's metal, cement, chemicals, aluminium, and electricity, importers of those products need to report on embedded emissions. And then as the program switches from transitional to the, let's say, the real thing, they will also then start to have to surrender certificates for that those carbon costs. On the right-hand side here, I put also a reminder of some of the key implementing acts for the EU ETS directive. It's been quite a busy year, I think, for the European Commission, churning out all these acts. So we had the Innovation Fund regulation. I think all of these that I will list now were passed or adopted from September to December. And this important change in the Innovation Fund regulation was that it introduces a competitive bidding to complement the previous system for awarding grants. The auction regulation that's provided the final confirmation of the EUA volumes that will be offered in the years to come. And that was very much awaited in December because EEX could not publish the auction calendar for 2024 before this one was finalized. And there was the registry regulation, which was amended to pave the way for the inclusion of maritime emissions from this year, and then eventually buildings and transport emissions, so the ETS2 from 2027. The Modernization Fund regulation was also amended, adding more funding and expanding the scope of countries that can be eligible recipients for support from this program. And finally, the free allocation regulation, which outlines rules on the conditionality principle, reviews benchmarks, and provides special allocation rules for district heating and some CBAM sector installations. So now let's zoom out a little bit to look at the long term. I thought it would be useful to have a reminder why policy has been and continues to be an important price driver. This picture here shows our cumulative balance and our annual balance. So this is for the years from 2008 until where we are now. This is based on actual numbers, and then our assumptions for the demand side and supply side out to 2030. So you can see that the oversupply here has been vast, above 2 billion. If you go back some 10 years in time, those who were in the market already then will probably remember the discussions back then, which led to the backloading, which is shown here as the annual deficits in 15, 16. And I mean, since then, basically the surplus has come down quite a lot. But I think if we let's move ahead to this one, which gives the supply. These are no longer just our assumed balances, but this is what the supply side is set to look like in dark blue here under the new rules. And the light blue columns show the trajectory under the previous framework that was based on a overall target of 40% reduction in 2030. So if we see, in the years to come, there's not that much of a gap, but the gap increases as we progress. And for 2030, with the Fit for 55 rules, issuance will be reduced 43% from current levels. And if we had remained under the old framework, it would still be around 1,200 EUAs issued in 2030, as opposed to 847 under the new rules. And of course, if we simply extrapolate based on these parameters, we get to zero issuance in 2040. Which is, I think, worrying to say the least for many industries, well, all industries probably, but especially for the the manufacturing industries that have quite a huge share of emissions that are hard to abate, and that we cannot reasonably expect there to be new technologies in place to deal with all those emissions by 2040. Just a second. So what that means in practice, of course, is that there will be a need for some action to be taken. Either we will see a massive abatement in all industry, or they will simply move away to different jurisdictions with less stringent climate policies, or more likely there will be new discussion to find alternative options, such as allowing for removal units. I'll get back to that in more detail as well, which would be then a way to, offset your own emissions by direct capture of emissions from the air, for example. But this is very new and yet untested technologies. But it is a discussion that is going to dominate the European climate and energy policy debates in the years to come. On the even further out, we might also see some increased push for using credits, international credits. The EU ETS had a history of that, and it, for many would say for good reasons, that was discontinued largely from 2013, and completely stop of that from 2020. But if we don't find alternative ways to deal with the residual emissions past 2030, that could potentially still re-emerge as a discussion point. So if we zoom in a little bit back to where we are right now, the big thing coming up this year is the 2040 target discussion. Europe has a 2030 target, at least 55% reduction. That is an absolute target. Then there is a 2050 target, net zero. So that's a net target, which already implies some room for removals or other ways to, to do the counting in a net way. And the question now is how to link those two targets and whether that target should be a net target or an absolute one. There was a consultation period on this started by the European Commission last year from April to June. I think the key input in that process was what came from the EU Climate Advisory Board, which recommends around 85 to 90% reduction already by 2040. So quite ambitious target. And the next element now that we are awaiting eagerly is the communication that is planned for the 6th of February. The European Commission has changed a little bit its original timeline for the 2040 target process. It's meant to come out with both a communication, impact assessment, and legislative proposal this year. But probably because of the upcoming European Parliament election, the legislative proposal is not set to appear before early 2025. But there will be the communication and impact assessment in February, and that will spur probably a lot of reactions from the member states. The current Belgian presidency of the Council has signaled that they want to facilitate discussions throughout its presidency. And I would expect also those industry stakeholders and others to come forth with the reactions to that communication. The way I understand it is that the impact assessment will, draw up and compare some various scenarios. But there has been indications from Climate Commissioner Hoekstra that he will be quite explicit in suggesting that the most ambitious scenario is the one that the lawmakers should settle for. There was a leak on this quite recently. So I mean, it's still some weeks to go, so the final documents might look a bit different. But from those leaks, it does seem that the Commission is envisaging a net target also for 2040, which would then de facto open up for use of removal units. Yes. So once those documents are out, we expect a lot of discussions, talks, and this could be, of course, an important price driver in 2024. Then we will have the Parliament election. I will get back to that a little bit more in detail later. But we could have the current plan then is to launch the legislative proposal in early 2025 and fast track that process in normal co-decision procedure with the lawmakers to have it ready and finalized before the 2025 COP. And once the 2040 target is set, we are not so far away from the ETS review that is planned to start in mid-2026, and which will obviously be then informed by the 2040 target and will need to then align to recalibrate the EU ETS to contribute to reaching that overall target. Yes, so if we go back a little bit to where we are right now in January 2024, this is again the price movements throughout 2023, and we see after a brief pickup in December 2023, we are again seeing a bearish start of 2024. We are actually at the lowest level since the invasion of Ukraine. And as I already mentioned, I think we have tracked gas prices lower on several occasions and are doing it again. And then what seems to be more and more confirmations of a gloomy economic outlook for the European economy, and in particular European industry. So in sum, we expect all this to lead to a muted demand for EUAs also in 2024. Our assessment as of now is for very flat developments in emissions, both for industry and power in 2024. So overall, this is seems to be predominantly bearish, and we are right now in the process of updating our near-term price forecast. We're hoping to get that out later this week, and if not, next week. So I have no numbers to provide yet, but we are surely, heading towards a downward revision of our near-term forecast. So, a few words on the fuel switching prospects for this year. So if we go back to 2023, then it was the front month CO2 switching price that tended to put gas in the money. The frontier was out of fuel switching range. And that dynamic with EUA prices moving in between the two helped set direction at times. This year, the picture is a bit different. As you can see here, the lighter line here is the EUA forwards from spot, front month, Q1, etc., up to frontier +3. And with the corresponding CO2 switching price here, which puts gas very, very clearly in the money for all contracts except possibly for Q4, where it's just crossing. And the point I want to make here is basically that if gas is clearly in the money already, a further drop in gas should logically not be that important as a price driver. But if the two lines are crossing or near, we could see could see EUAs taking direction from that. And now we are approaching the 45 minutes. Well, I'll try to speed up. So if we go to a little bit more in detail on the 2040 climate target. So the timeline, I see I already mentioned some of this. There was a consultation last year. And sorry, the advisory board recommendation was for 90 to 95% reduction target for 2040, that is. So that's, would mean doing most of the abatement required by 2050, already by 2040. And next up now is what the Commission will present on the 6th, so the communication and impact assessment I mentioned already. And there will be a parallel communication, probably on the same day, on the industrial carbon management strategy. And that's the leaked draft of that text suggests room for using removal units. Again, this should not be maybe that much of a surprise, because there is also in parallel an ongoing process on the removals framework, which is in trialogue and will hopefully be concluded also this winter, spring. Yes, once these documents are out, we expect discussions to start in Council, whereas in European Parliament, it's probably not that much of real negotiations in the present term, since it's going to be a new parliament elected in the June elections. So on the council side, they might be ready to decide this year. Parliament probably not before early 2025. And some key questions here. I've touched upon this briefly already, but the whole idea of a 2040 target is to link the existing ones. So it's important to decide on a number, and also whether that should be expressed as an absolute or a net target. And if it is a net, it would open up for other ways to count towards that number. Also very important, what will be the burden assigned to ETS sectors? Currently, the abatement burden is higher for ETS sectors than for non-ETS sectors. The picture is getting a little bit more complicated by the fact that there is already a decision to start the ETS 2 for road transport emissions and buildings emissions. As of now, there is no concrete plan to merge the two, but that might eventually happen. There has also been some talks, suggestions of expanding the scope further to include agriculture. There is quite strong opposition to that, so that would be, I think, it doesn't seem likely right now, but it's probably something that will come up again in the discussion. Quick reminder of some key points to look out for this year. I guess not everything here is super important. All the auctions, the extra volumes, they are in place. We'll add some 87 million EUAs in 2024. The 6th of February will be a key date. European elections, and then appointment of a new commission. Ursula von der Leyen is generally seen as the lead, and so far the only explicit candidate to my knowledge, but it remains to be seen, of course. Yes, and one thing I could have added here probably is that 2024 is the first year with a new compliance cycle. So there will still be reporting by end of March, verified emissions 1st of April, except it will be the 2nd of April this year because of Easter. But surrender deadline for compliance is no longer 30th of April, but 30th of September. So that's also something to remember for the calendar. Right, but then I think I'll try to summarize how we see price drivers for this year. So if we start on the bullish side, elements that are set to tighten supply. This is the start of the new framework, Fit for 55. So with a new LRF cutting roughly 84 million tons per year, as opposed to 43 million in the under the old parameters. There is also this so-called rebasing, a one-off cut, or rather a first of two one-off cuts, 90 million tons being cut this year. There's the inclusion of maritime. So maritime is obviously introduced both on the supply side and on the demand side, but if we see hedging activity from maritime, there could be this might qualify as a bullish factor. Maybe more important here is this is also the year where the aviation sector no longer receives free allocations, so they will need to purchase at auctions or in the secondary market. And then on the other side, you have the additional auction volumes coming from the repower sales. So those 87 millions, they very closely outbalance the cut that is done under the rebasing. So there is a modest growth prospects for economic activity in Europe, and emissions are set to remain low. So this will also weigh on prices. Gas is in the money for power, not coal, as shown on the fuel switching slides. And the last point here is that the new parliament might end up less climate ambitious. This is, of course, a bit speculative, but there are signs suggesting that both that the far right will probably gain more seats than they currently hold in the parliament, and also that some of the existing leading party groups, most notably the center-right EPP, which have been an important part of the pro-climate consensus, or the big four-party majority. Within that group, there have been increasing calls for, some have talked of putting the climate legislation on a pause, or a similar kind of language. So we'll have to wait, see with the new parliament how that will play out. But there is reason to expect slightly less climate ambition from the new parliament. So with that, I see we reached 10 to 3. So I think I'll hand back to Helene then and see if there are any questions from the audience.
Thank you very much, Anish. We have a few questions that's come through. In your earlier slides, you showed a graph about the EUA prices, and where the prices above fuel switching range is bullish and the one below is bearish. The question is whether this run counter to intuition, where EUA prices below fuel switching range should stimulate more relative coal generation and therefore greater emissions demand?
Right. Okay. Let me go back to the slides. It will maybe be more easy to explain. If we take this one, I guess this was the one in question. I just need to get back to full screen. So, well, the idea here is that the fuel switching price here between, so where are we, February, March, and to October, we were in let's say fuel switching territory, because it made economic sense to switch from coal to gas burning, because the switching price was lower than the actual EUA price. Whereas here in January, early February, and again a period in December, the carbon price, you could turn the argument around and say that the EUA price was not, it would have needed to be, up here above 160 to spur coal to gas switching also in that period. So I hope that answers the fuel switching question. It's a little bit hard when I cannot see the audience, but
Hopefully.
yeah.
Due to time, let's move on.
Yeah.
On slide number 10, you show that the cap will be zero in 2040.
Mm-hmm.
But the question is if that's true. And what about the EU AA allowances, which have a different cap? Will they also be zero in 2040?
So let's go back to, well, I guess it's this one.
Mm.
So, I mean, no one knows yet, right, what the cap will be in 2040 because the existing framework ends in 2030. So this is just extrapolation. But using this, we see that the last fresh EUA is issued in 2040. And I guess it's fair to say that whatever 2040 target is decided and whatever the assigned share of abatement will be given to ETS sectors, it's more likely that it will be more ambitious than this rather than less ambitious.
Mm.
Hence, the importance in finding, say, alternative ways, such as removals. Otherwise, European industry will be a very, very difficult situation in 2040.
Good. And what are your expectations for power emissions for the coming year, considering the trend of having warmer winters but also hotter summers? Is the fall in emissions from the power sector set to continue, you think? And if so, how many percentage-wise?
Yeah. So our preliminary forecast, emission forecast for 2024, we see power at completely flat compared to this year. So we had, in our assessment, power sector emissions of 574 megatons in 23. And we expect that to be 575, so up 1 megaton or 0.2% in 24.
And do you expect the first half of the year to be bearish for EUAs and later part to be a bit bullish given the surrender deadline has moved? Or what could be some of the bullish factors you see for the coming year?
I mean, it's such, I think I can be already now quite clear that we probably will, adjust downwards our near-term price forecast for the second part of the year. We are not really decided on that yet, but in the long-term context remains right. The increasing tightness beyond 2026. So I do expect that will provide some kind of floor to price movements, but exactly how much it's something that we are still trying to assess and balance up against the economic situation. Any uptick in the economy would, of course, also be a bullish signal for carbon. As would if gas prices were to rise dramatically again, that would, of course, also then put coal back into the money for power generation, which would also be a possible bullish driver, although there is nothing suggesting that right now.
And then there's a question about the 2040 climate target timeline, whether you could please elaborate on communication in terms of context.
Mm-hmm. Yeah. So the point that I tried to make here was that I think the Commission, they started this process last year. There was a public consultation that didn't draw that much of interesting feedback. Well, I should not pretend that I looked through all of it very thoroughly, but the key element was the input from this scientific advisory board. And then in the early part of the autumn 2023, the idea was to, from the Commission side, to come out with a proposal by June 2024, and that would then be also the legislative proposal. But then they changed that timeline to split it in a way, and concentrate on a communication and impact assessment that would come in the first part of 2024, and that has now been the general expectation is that it will come out on the 6th of Feb after a College of Commissioner meeting earlier that day. And my interpretation, at least, is that this was one of the reasons was probably because of the parliament election and the realization that it would be, not really wise move to have the parliament start negotiating on that. On the other hand, the member states can and probably will start now. So so we expect that to happen and go on throughout this year. Whether there will be some kind of political agreement in the autumn, I mean, giving the new parliament some time to decide their position, for sure. But I mean, it would be a very short timeline, but it's not completely impossible to imagine that there could be a political decision by the end of this year, in which case that legislative proposal to come out early next year could indeed be fast-tracked if the political discussions have already been taking place up front.
And then a very brief one before we finish off. Will you consider the impact of carbon reduction initiative to have a big impact on the balances?
So maybe that refers to the industrial carbon management strategy. If so, I think that's also a little bit early to say. We'll have to wait and see what comes out with the communication in February.